Hello and welcome everybody to MEPL Classes. I am sorry for the delay, but I think there was some issue with the live stream on YouTube. I had already started my class 15 minutes earlier on time, but there due to some issues on the YouTube live streaming, we could not stream live. In the 15 minutes, we have just done some basics, and I'll just go through them again so that you can get an understanding of what we have done in the last 15 minutes. Okay, so today's class is on LOS 18, Understanding Income Statements, and we read about what the CFA Institute wants us to know after completing this chapter. So this is just an overview of the table of contents for this chapter. You can just go through this. You do not need to memorize or learn this thing. Then we learnt about the components of income statement. An income statement is what we learnt about yesterday also. It is the statement of financial performance of a company, and it is commonly referred to as the profit and loss account or the income statement. The components include revenue, which only describes the sales or turnover of a company. For a manufacturing company, it might be that the company is selling their products. I might be manufacturing steel rods. So if I sell those products, the revenue that the amount of money that I get for selling those products to my customers, that is referred to as a revenue. For an app based or internet company, it might be advertisement revenue. So the money that the company receives for selling advertisement space on their website is referred to as revenue for the company. So revenue might mean different things for different company. Basically, it means the money that the company is generating for the sale of the service or their product, which is the primary operations of the company. Next, we understood expenses. Expenses refer to the costs that are incurred to generate those revenues. These might refer to the salary that the company has to pay to its staff. It might be the rental expenses to rent the offices of the company, or instead it might mean the rent of the final shop. It might There might be several expenses that the company is incurring to generate the revenues of the company. So everything in total is known as expenses. We also came to know that expenses can be grouped and reported in different formats. So like yesterday, we'll go back to the financial statements of Meta and see revenue will always be the top line item. It is reported in first, because the first thing I want to know is how much revenue is the company in which I'm investing is generating. Next, we came to know about how the expenses are grouped together. Similar expenses are grouped. If you see, you'll find that there is no salary mentioned in the entire expense chart. So does that mean that a company like Meta is not paying any salary? Obviously that is not true. They have hundreds and thousands of staff. So the staff salary, which is an expense to the company, is recorded under several of these heads. The administrative staff salary might be included under general and administrative expenses. The marketing staff salary might be included under marketing and sales expense head. And the R&D staff salary might be included in the R&D expense head. So this is how we came to know what expenses are and how they are grouped in an income statement. Then we went to gains and losses. Gains and losses refer to non-operating items. The company might have several gains or losses relating to items of non-operating nature. These might include sale of land. The company might have invested their excess money into land or building. So if the company sells this land at a future date of time, at a profit or loss, the such profit on sale of land can be categorized as gains. Or if there's a loss, then it might be categorized as losses. So any non-operating nature of gains or losses are referred to as gains or losses. So finally we came to net income. Net income can be calculated as revenue, which is nothing but the sales figure of the company, minus operating expenses and other expenses. And finally we added other income and the net of gains and losses. The summation of this entire thing gives us net income. I hope everybody is up to track till now. Okay. Okay, so moving forward, this is all we had done till now. Now moving forward, let's understand what about minority interest. What is minority interest? So this is an interesting concept that we all need to understand. For this, let me open my notes. Okay, so here we are. Let us say I am a parent company. This is the main or the parent company. Let us call it XYZ Limited. And the as a parent company, I invested in two companies. This is ABC Limited and this is PQR Limited. So XYZ Limited holds 100% shares in company ABC and 80% shares in company PQR. So in this case, XYZ is the parent company because I am the owner of these two companies. I hold the shares of these two companies. ABC and PQ are known as subsidiary companies. Now ABC is a wholly owned subsidiary, whereas PQR is a partially owned subsidiary of the company. So for ABC Limited, the entire company belongs to XYZ, whereas PQR only 80% of the company belongs to XYZ. Okay. So now when I go on to prepare the financial statements, there are two types of financial statements which I can prepare. One is the standalone financial statements and the second is the consolidated financial statements. When we were seeing the financial statements of Meta, what is written here? Is it a consolidated financial statement or a standalone? This one is the consolidated statement of income. Let's go to the table of contents, form 10K. Wait. This is the consolidated balance sheet of the company. Standalone balance sheet. Okay, so they have not reported, but there is one standalone balance sheet in which only the figures of the parent company is reported. That means the sales and expenses of XYZ Limited is reported in the standalone financial statements. And when we report our consolidated financial statements, what we report is the combined revenue of all the three companies. So in the case of Meta, when we saw that they have reported the consolidated financial statements, that means it includes the revenue of Facebook, WhatsApp, Instagram, and any other company that they own. So the consolidated means parent plus subsidiary. So parent's revenue plus subsidiaries revenue is together reported in the consolidated financial statements of the company. So now we heard that how ABC Limited is 100% owned by XYZ. So in that case, there is no issue. We can report the entire revenue as our own. When I'm telling my XYZ, so let us take some numbers. XYZ revenue is 100, ABC revenue is 50, and PQR revenue is 30. So if I report my revenue as 180, I say that that is the total revenue that I am earning. Is that entirely correct? No, because 80% of PQR is owned by me. The rest 20%, so 20% of 30 is owned by somebody else. So revenue I might state, but when we reach to the profits, the entire profits do not belong to the parent company. The parent company only holds 80% of PQR. So the balance 20% that is not owned by the parent company is known as the minority interest. So that is known as the minority interest of the company. That is referred to as the minority interest of the company, and we need to make sure that we are taking out the minority interest component from the final comprehensive income portion so as to give us a true figure of what the company is earning. So if I say that the profits of XYZ is 50, the profit of ABC is 20, and the profit of PQR is 10. When I report in the consolidated financial statements of XYZ, I will say that the consolidated profit is 50 plus 20 plus 10, that is 80. And then I will be subtracting minority interest of 20% of 10, that is 2. So my final comprehensive income that I will be reporting to my shareholders will be 78. You just need to know the concept of minority interest, and if you understand what does minority interest stand for, that is enough for your examinations. So I hope everybody understands the meaning of revenue, the meaning of expenses, gains and losses, net income, and finally minority interest. Let's move on. There are two presentation formats for our income statement. Our income statement can be presented in the single step format or the multi-step format. So for single step, all revenue and all expenses are grouped together. There are no subtotals. Whereas in multi-step, it includes subtotals such as gross profit and operating profit. Let us see an example. In this single step format, we can see there is just one heading for revenue and one heading for expenses, and we get the net income. So all expenses are listed under expenses and losses, and all income is listed under this one line. However, is this the right way to present? Do I get a whole picture? What if I need much more detailed information? What if I want to know more about what each line item describes? That is when we move to the multi-step format, multi-step presentation format of an income statement. See, so what we have done here is the revenue from operations and the cost of goods sold. That is the direct expenses, cost of goods sold, or this is also known as the direct expenses for a company. So the cost of goods sold are direct expenses. Once we subtract the direct expenses from our revenue figure, what we get is the gross profit of the company. This is the gross profit. Then after gross profit, we subtract the other operating expenses. So first let us understand what are direct expenses. For a manufacturing company, the direct expenses are the cost directly related to produce the product. Let us go back to a steel example. I am producing steel plates. Then the raw material of steel, the machinery, the labor, that is the direct expenses. And what are non-direct expenses? My marketing expenses. These are also operating. These are expenses which I am using directly for my operations. But these are not directly related to the production of the product. Hence, these are non-direct expenses but operating. So the operating expenses such as selling expenses, like I said, the commission expenses that I may pay to my staff, admin, that is an accountant is preparing my accounts for the year, that is used for my operations. However, that is not directly related to my production and that is not a direct expense for the company, hence it is shown as operating expense separately here. So after we reduce the other expenses, other operating expenses such as selling and admin expenses from the gross profit, what we get is we get operating income of the company. This is also known as EBIT or earnings before income tax, before interest and taxes. So EBIT or earnings before interest and taxes. Interest expense is not an operating expense for the company. I hope you all remember that from yesterday. Interest expense is a financing expense that is not related to operations of the company, right? So we deduct the interest expense after the operating income and we get the net income. This can further be written as net income or PBT, that is profit before taxes. Once we finally reduce the taxes from this figure, what we get is the final line item, that is the PAT or the profit after taxes. I hope everybody is clear till now. This is the single step format and this is a multi-step format. In this we are getting a much more better presentation. We are getting to understand what are the expenses that are incurred for direct production of the goods. We are getting to understand what are the other expenses relating to operations. If they are non-operating items, they are also deducted after. For example, interest expenses. These are also deducted after we get the operating profit or operating income. And after deducting interest expense, we get the profit before tax or PBT. And finally, after deducting the taxes, we get profit after tax or PAT of the company. Okay. So there are some important concepts that can come in your exam. You can be asked the meanings of simple step and multi-step format. You can be given an example and you can be asked whether this is a simple step, multi-step or some other kind of format. And I hope that you will be able to understand and distinguish between the two types of formats. And there are two important concepts that you need to know, which we already heard about. Number one is gross profit and number two is operating profit. We need to know the meaning of these two profits before moving forward. Now, the gross profit is the amount of revenue that is available after subtracting the cost of delivering goods or services. Delivering goods or services is basically the direct expenses of the company which we just discussed about. So the direct expenses means the cost of delivering goods and expenses. An income statement that shows a gross profit subtotal is said to be a multi-step format. So we all know that if the gross profit and operating profit is given, then we will call it a multi-step format of income statement rather than a single step format. Other expenses are related to running of the company will be subtracted after the gross profit. Here we saw the other expenses is deducted after we get the gross profit, right? So the every other expenses relating to operations are also deducted once we derive our gross profit. Next, let us come to operating profit, sometimes referred to as earnings before interest and taxes, is the result of subtracting operating expenses such as selling, general and administrative expenses from gross profit. It reflects a company's profit from normal business transactions before making deductions on tax and interest. We already read this and understood this here. These are the expenses that are related to the operations of the company but not directly. So we are putting it here. Operating expenses Once we get the operating profit, we deduct the interest expense and any other non-operating expenses to get the profit before tax. And finally, after deducting the taxes, we get profit after tax. I hope everybody is clear with what we read in this slide. Now, we will come to the technical portion of today's class. We will be learning about two important accounting standards. The first one we are going to read about revenue recognition. What is revenue recognition? Yesterday we understood how accrual principle is relevant for companies. We do not record the revenue when we actually receive the cash for selling the revenue. If I sell you a product and you say that you will pay me tomorrow, I will still record the revenue in my books of accounts. However, I will record that along with a debtor. I will say that I have accounts receivable or I have money receivable at a future point of time. I will record such debtors as an asset for my company. So this means that I'm recognizing my revenue in my books of accounts before we actually receive the cash. So what is the point of time when I can record the revenue? Should I record the revenue when you just say that you might buy it from me? I go to a seller and say that I might buy this projector from you tomorrow. Is that the point when the seller can record his revenue? Or when I actually record it, or when I actually place the formal order, I place a formal written order. When do you think a proper recognition of revenue is suitable for the company? One second, I have an announcement. Okay guys, so I have an announcement to make. Please go to meplclasses.com to buy our CFA courses, and you can use the code MEPL 2023. So that is MEPL 2023 to avail a huge discount. Please go to our website right now and you can get a huge discount on our product. Thank you so much. Now coming back to revenue recognition. When do you think is the right time to recognize the revenue for selling the product? Now, this is described from the standards, the accounting standards that are set by the standard setting bodies. For the, like we said, for the United States, it is the FASB, and the standards that are followed in the United States are US GAAP, or the United States Generally Accepted Accounting Principles. For the international community, it might be the IFRS. We have mentioned everything below. Okay, so again, let's go through what's written on the slide and then we will understand one by one. Revenue is reported as the top line item on the income statement, which you already saw. Accrual accounting allows revenue to be recognized, that is reported on the income statement when it is earned and not necessarily when cash is received. We have already discussed this. In May 2014, IASB, or the International Accounting, we already discussed IASB and FASB yesterday. I hope everybody remembers IASB and FASB. These are some things that you can be asked in the examination. These are the standard setting bodies, IASB the international body and FASB the United States body. So they issued a converged standards for revenue recognition. The standards take a principle-based approach to revenue recognition issues. According to the standards, there are 5 steps. There's a 5-step process that needs to be followed for recognizing any sort of revenue. Let us understand every step one by one. First is identify the contract with the customer. What is a contract? Any agreement between two people is referred to as a contract. A contract is an agreement between two people to buy or sell goods or services. And the defining point of a contract, it must state the rights and obligations. Depending on the company, a contract might be written or verbal. Some countries accept both verbal and written contracts, whereas others might only accept written contracts. So first we need to identify the contract with the customer. Let us say I went to you and I say I want to buy a product, and you accept to sell that product to me. Then we have an agreement. We have an agreement where I will buy the product and you will sell it to me, and I will give you consideration or money in exchange for that product. Identify the separate distinct performance obligations in a contract. What is a performance obligation? A performance obligation is nothing but a promise to deliver goods or services. Now, for example, I buy a good from Amazon and they say that they will sell that product to me and they will deliver it to my home. So how many performance obligations can you identify in this contract? There are two performance obligations. The first is to deliver the good. The first is to sell me the good, and the second is to give it to me at my home. The delivery, the service of delivery is also a performance obligation that is implicit in this contract. So these are the two performance obligations. It might differ from contract to contract. For example, in a after sales service agreement, I bought a water purifier and I have an after sales agreement with the company. They say that they will not only sell me the product, they will provide after sales service. So again, there are two performance obligations. One, to sell me the product, and two, to provide after sales services. So the company needs to identify the after sales services. 1 second. I cannot find my pen. There is this. It rolled under my keyboard. Sorry. Okay. So moving on. Once we have identified that there is a contract in place, that there is an agreement with the customer, and second, we have identified the separate performance obligations with the company, with the customer, then we come to determination of transaction price. A transaction price is the amount that the company expects to receive from the customers in exchange for transferring the goods or services. Okay, so it says that the customer that I expect to receive. So for example, as a company, I am selling a product and I'm saying if you make the payment within 10 days, I will give you a 5% discount. So does that give incentive to the buyer to pay me within 10 days? Yes. And as a seller, I will have to determine whether I expect to receive the entire sum of money or do I expect to receive 5% less. Accordingly, I will recognize only the portion of revenue which I expect to receive. If I expect to receive a 5% discount, I will recognize a revenue at 5% discount. Now, the transaction price can be both. It can be fixed or it can be variable. To give an example of fixed, the MRP that is written on products, that is a very good example of fixed price. If I go and buy a chocolate from a shop, they will have an MRP written on the product and I will have to pay that amount to get the product. I know that this is a fixed revenue. That is a fixed sum of money. That is a fixed transaction price. But let us consider something much more big. Let us consider a construction, a building construction. I am a construction company and I am going to construct a company for my buyer. And against that construction of building, we have determined that he will be paying me $1 million for every year of construction. The construction is going to take place over 3 years. However, there is also a special mention that if I complete the construction within the prescribed time, I will get a 100,000 bonus. So that 100,000 bonus is variable. I am not sure whether I'll receive that bonus or not. So do you think I should record that 100,000 bonus as revenue in my books of accounts? Is that the right way? Should I recognize the bonus in my books of accounts? That is not ideal. But if the company's management is sure, 2 years have elapsed and the company's management is sure that they will be able to deliver the product within time, and there is certainty that the bonus amount will be received, then the company is entitled to record that variable income, the variable transaction price, as revenue in their books of accounts. The fourth step is allocating the transaction price to the performance obligations. When there are multiple performance obligations and only one transaction price, for example, like I said, that I am going to sell you a product and deliver it to your home, to do performance obligations. However, I ask for only $100 from you for it. I ask you for $100 for delivering a product to your house, which involves two performance obligations: giving you the product and delivering it to your house. So I need to determine how much of that transaction price is allocated to the product and how much is allocated to the transportation delivery service that I'm providing you. And what is the right way to determine? We can see the non-delivery price. For example, I have two customers. Customer A and B. I am delivering it to customer A's house. For customer B, he comes to collect himself. So for customer A, I am charging him $100, and customer B, I am charging him only $80. So it is very clear that in this case, the additional $20 that I'm charging from customer A is for the delivery service that I'm providing. So I need to make sure that the delivery service is separately mentioned and the performance obligation is getting the transaction price that is allocated to it. However, we should also understand that although in this case it is very straightforward, there are certain cases where the allocation might be a bit complicated. We need to understand the complications and give the answer according to the question. However, I do not think that such complicated questions should come in the CFA exam. And finally, we should recognize revenue as and when the performance obligation is satisfied. So like we mentioned that we should recognize the revenue. We should recognize the revenue as and when the performance obligation is satisfied. For a construction company, it might be that they have said that they will complete the entire construction in 3 years. However, the performance obligation might be divided into many subparts. Example, the first portion might be to form the structure of the building. Once the structure of the building is complete, it might say that the first performance obligation has been satisfied, and that is when that revenue can be recognized by the company. The second might be the completion of interior decoration, or it might be the completion of the terrace. There might be different performance obligations that might be identified by different companies. So accordingly, as and when the performance obligation is satisfied, that is when the revenue or the transaction price relating to that performance obligations needs to be recognized as revenue by the company. I hope you are clear, because this is a very important question and this can come in your exam. You can be mentioned, you can be asked what are the 5 steps that are involved And you can be since CFA is an MCQ based test, instead of asking what are the 5 steps, they can mention one step and say whether or not this is a part of the revenue recognition process. So they might ask whether determination of the transaction price is a part of the revenue recognition process. So you need to be sure of what the 5 steps are so that you can answer that question. There are 5 steps to solving this question. I hope everybody is clear with it, because this is very important for your examinations. Revenue recognition it is a accounting principle and an accounting standard. Treatment of related costs. Now, what are the related costs relating to any revenue? Incremental cost of obtaining a contract or fulfilling a contract must be capitalized. What does this mean? So let us say that I am going to obtain a long-term contract. Coming back to our construction company example, I bagged a deal of constructing a building, and the construction is going to take place over 3 years. I spent $10,000 on obtaining that contract. So should I expense that entire cost in 1 year, in the first year of incurring, even though the expense has been incurred? I've already paid the cash. No, that is not right, because the expense relates to the 3 years of revenue that I'll be earning. So what I need to do is I need to capitalize it over the 3 years, right? I need to capitalize the expense, and one by one. So like I said, 10,000. So I need to capitalize, I need to expense $3,333 every year. That is what it means to capitalize the incremental cost for obtaining the contract. Next, if incremental costs are expensed in the years before adopting the converged standards, then the company's profitability will appear higher than the converged standards. What does this mean? So like we read here, that this standard was introduced in May of 2014. What if a company did not follow any revenue recognition standard before that, and they expense the entire $10,000 in 1 year alone? In that case, can the company truly say that they have done proper presentation of their books of accounts? As per the prior standards, that was allowed. So that was not incorrect on part of the company, but that is not a fair representation, since the expense relates to the 3 years of revenue that we are earning. We have already understood that. So we just, as a financial analyst, we need to make sure that if we are reading the books of accounts of a company prior to 2014, we need to keep this in our minds, that the incremental cost might have been expensed in 1 year. So 1 year's revenue, 1 year's profit will be much lower than the other 2 years in which there's no expense being booked by the company. So this is something we need to keep in our minds as financial analysts, so that we can make a fair representation of our analysis. And finally, there are certain disclosure requirements that we need to know for the revenue recognition standard. Number one, contracts by customer category. Like in Facebook, we saw that the company has different business segments. App based, they have a lab segment. So there are different customer categories. So the contracts by customer category is something that they need to mandatorily present in their annual report. This is a mandatory requirement for the revenue recognition standard. Number two, assets and liabilities related to contracts, including balances and charges. So if there are separate assets and liabilities relating to one particular contract, like in the construction company, that one building that we are constructing to sell is relating to one contract. So that is a separate asset for that particular revenue. We need to record those assets and liabilities and present them in our balance sheet or the statement of financial position. Number three, outstanding performance obligations and transaction price allocated to them. We already know the meanings of performance obligation and transaction price. We need to make sure that the outstanding performance obligations, that is the contracts that the company has already entered into, and the performance obligations that I'm liable to do in the future are disclosed, and the transaction prices that have been allocated to each of those performance obligations. That is self-explanatory. And finally, management judgment to determine the amount and timing of revenue recognition, including changes to those judgment. Like I already said, the variable transaction price that we talked about. Let us say that the company expects to receive a bonus if they complete their work on time, and the management in year 2 expects that they are going to do it in time, so they record the additional revenue. Now, in year 3, due to some, let's say, COVID occurs and the contract is deferred, and now the management will not be able to complete their product and will not be able to deliver the product on time. In this case, should the management still continue to record the additional revenue, or should they write that back? The correct answer is obviously write it back. So in this case, the management's judgment is whether or not the variable transaction price will be receivable by the company, and the management's decision and judgments should be disclosed. And if there are any changes in the judgments, then it should be separately disclosed. Like the bonus we mentioned, if the bonus is initially expected to be received and at a later point of time the bonus is not expected to be received, then there is a change in the management's judgment, and we need to disclose this change accordingly. Okay, so we have completed the first section of this chapter. I hope everybody is up to the mark and you have having no issues in understanding what we are teaching right now. Let us take a short 10 minutes break. It is 10:58. We will be back by 11:10 a.m. Take a short break, have your morning tea, and I'll see you back in 10 minutes. Okay, so welcome back everybody. Where were we? Okay, so before moving forward, let's just go through revenue recognition points again till everybody is back. From revenue recognition, we read that contracts, we need to identify the contract with the customer, then we need to identify the separate distinct performance obligations, we need to determine the transaction price, allocate the transaction price to the specific performance obligations, and recognize the revenue as and when the performance obligations are satisfied. Now, two things additional which I would like you to know is that a firm should recognize revenue only when it is highly probable that it will not be reversed. Like in the bonus scenario, we should make sure that the bonus is recognized when it is highly probable that it will not be reversed. In case the management has any doubt that it might be reversed at a future date, then such revenue should be deferred. It should not be recognized. And next, for long-term contracts revenue is recognized based on the progress towards completion of the performance obligation. So long-term contracts should be the revenue should be recognized based on the progress towards completion. Or we can use using the percentage of completion method. Right? So we can use a percentage of completion method. Again, let's getting back to a building example. How do we calculate the percentage of completion? How do we calculate the percentage of completion for a building? There might be two ways. Number one is the input way. Input way is the cost. For example, the revenue I expect, the total revenue over the 3 years is $100,000. And the total cost of constructing the building I expect is, let's say, $80,000. Now, after year 1, if the expenses incurred is $20,000 after year 1. So how much expenses have been incurred as a percentage? As a percentage, $20,000 divided by $80,000 equals to 25%. We know that 25% of the building has been completed based on the input side percentage of completion. Right? So we can recognize 25% of 100,000, that is $25,000 as a revenue. So that is how the input side percentage of completion or progress towards completion works. Or else it can be the output side. The output side means that an engineer might come and say that 30% of the building is complete as per his best opinion. A civil engineer might say how much of the output is ready, and based on the engineer's assessment of the output and the percentage completion of the output, that is how we might recognize revenue. Both of those might be correct depending on, again, which country you are in and whether or not the standards of your country allow this. Okay, so this was all about revenue recognition. Let us move forward. Let us move forward to expense recognition now. We have already heard about how we recognize our revenue. Now, revenue and expenses are two sides of the same coin. We already know that. When should we recognize revenue now? A company recognizes expense in the period that it consumes the economic benefits associated with the expenditure or losses. Some previously recognized economic benefit. What does this mean? It sounds very complicated, but it is not. It's very simple. Basically, the revenue should be recognized in the same period in which the benefits relating to that expense incur to us. For example, let us say I am conducting a marketing campaign, and the marketing campaign is for 1 week in on the Facebook platform. I do 1 week of Facebook ads. Now, during those Facebook ads, the 1 week of Facebook ads, the benefit of which I expect to receive over a period of 1 year. So that expense of running the ad on Facebook, I will be recognizing that ad in that year in which the benefits relating to that expense incur or accrue to me. This is nothing but the matching principle. This is called as the matching principle. Matching principle means a company recognizes some expenses whenever the associated revenues are recognized, thereby matching expenses and revenues. Matching requires that a company recognizes the cost of goods sold in the same period that the revenue from the sale of goods is recorded. So, for example, in the year 2021-22, I sell 100 goods. Let us say I am selling steel sheets. I sell 100 products. And for selling those 100 products, I incurred the cost of raw materials. I bought the raw materials to produce those goods. I bought several marketing campaigns. I rented out my shop. Everything I did to sell those 100 units of steel sheets. So every expense relating to those 100 units should be recognized in the same period when those 100 units are being sold. I hope it is very clear that the expenses and the revenues needs to be matched in the same period. Next comes the periodic costs. Expenses which cannot be tied to generation of revenue are called periodic costs. What does this mean? Let us say rent. Now I am paying the rent for this studio apartment, right? And from this studio apartment, I might be doing a lot of things. And the 1 year of rent that I am paying for the studio apartment, I might accrue the benefits of this rent even at a future date, right? Because this rent is a periodic expense which I have to pay every month. I cannot specifically say when I will be getting the benefit from this expense. Since this periodic expense is not specific, we need to understand that this needs to be recorded as an expense in the period in which it was incurred. This is not specifically tied to any one revenue, and it is being incurred on a periodic basis. They are expensed in the period in which they are incurred. For example, the rent paid for office premises are simply expensed in the period for which the rent was paid, and they are not specifically tied to any specific revenue. I hope that this is very simple and clear to everybody. Now we are getting to specific expenses. Before starting inventory expense, we should all know that there's a separate reading on inventory later on. So we will not go into very details right now because we'll be reading everything about inventory at a future reading in level 1 only. Okay. So accounting standards permit the use of following methods to allow inventory expense. Let us take examples to understand. Let us say I'm a bookstore. But let's stay with the same example, steel sheets. I sell steel sheets. Okay. I bought 100 units during the year for $10 each. Okay. Then I buy another 100 units for $20 each. That comes to 2000. Now when I'm selling these products, there is no distinction that can be made between the steel sheets. Everything is uniform. So how do I know which steel sheet I sold? Should I, as per the matching principle, we know that the expense relating to a product should be expensed in the same period in which the revenue is recognized. Now let us say I sell 150 units. For ease, let us consider for $100 each. So I earn $15,000. Okay. So how much expense should I record in my books of accounts? How much expense should I record in my books of accounts, everybody? I should record on a, there are 4 methods that are generally accepted. There might be other methods, but we will talk about 4 methods that are mentioned in the accounting standards. The first is FIFO method, or first in, first out. We will assume that the goods that were purchased first are being sold first. So in this case, the 100 units for $10 was purchased first, and the second purchase was for $20. So in the 150 units, I will expense 100 into 10 plus 50 into 20 equals to 2000, right? So I will expense $2,000 in case I am following FIFO method. So for FIFO method, my profit will be $13,000 since the prices are increasing and I am taking the lower priced items, that is the first items that I was bought, that are being considered in priority. This is called FIFO. Second is LIFO. This is the complete opposite of FIFO. This means last in, first out. We are assuming that the goods that were purchased last are being sold at a priority and are being sold first. So 100 multiplied by 20 plus 50 multiplied by 10. This comes to 2500. In case I am following LIFO, in this case, we will be having an expense recognition of $2,500. So can you see the difference? FIFO and LIFO, these are the 2 methods. And the most important thing that is very relevant for your exam is LIFO method is allowed in US but not allowed in IFRS or the International Financial Reporting Standards. US GAAP allows the use of LIFO method, but IFRS does not allow the use of LIFO method. This is very, 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 very important and it is very relevant for your exams. This has come in the exam many times. Not permitted in IFRS but permitted in US GAAP, LIFO. This is very important for your exams. Keep this in mind. First in, first out and last in, first out methods. Next we come to weighted average. As the name suggests, it is the middle ground or the average of the two figures. This method is also permitted. So in this case, our total cost was $3,000 for buying 200 units. This comes to $15 a unit, right? So in case of weighted average, the expense we are going to recognize is 150 multiplied by 15, which comes to 225, 2250. Weighted average will always be somewhere in the middle of FIFO and LIFO, right? Excuse me. And finally, last but not the least, is specific recognition. Now this method is not used for homogeneous items because it's not possible to specifically identify the sheets. Now if I say I sold sheet A or sheet B, as a steel sheet seller, I won't be able to differentiate between the two. But let us say my business is of diamonds. Every diamond has a distinctive identity. They are different in some way or the other. My drawing is not very good. I hope you see that this is a diamond. If I'm in the jewelry business, then whenever I'm recognizing revenue, I will know exactly which good has been sold and how much did I spend to buy that particular jewelry. So in case of such businesses where the items are of high value and they can be specifically identified, then the specific identification method of expense recognition is followed. So this is specific identification. Identifies each item in the inventory and uses its historical cost for calculating COGS. I hope you remember the meaning of historical cost from yesterday's class. Okay, so now let us do one question. What is the specific kind of question that is asked in the exam? Let us say we are in an inflationary market. What is an inflationary market? Where the prices are continuously rising. The opposite of this is deflation. So deflation is where the prices are falling. So in case of an inflationary market, the prices are rising. Prices of goods rising. So in such a market, what kind of inventory policy will give us the highest profits? Maximum profits. Options: 1 FIFO, 2 LIFO, 3 weighted average, and 4 specific identification. What do you think is going to give us the what is going to give us the maximum profits? Which policy of inventory should we follow to give us the maximum profits? So we know the prices of goods are rising, right? In a rising prices market, we need to recognize the minimum expense to give the maximum profits, right? So in this case, FIFO is the right answer. Why? Because in FIFO we are expensing the goods that were purchased earlier at we are expensing the goods that were purchased earliest right now. So the goods that were purchased earlier must be of lower cost since the prices are continuously rising. So if we show it on a chart, time cost. Inflationary market is as the time is going forward, the prices are going upwards, right? So the goods that were purchased earliest will be the cheapest. And if we expense the goods that were purchased earliest right now, then we will be able to recognize the maximum profits. So the FIFO policy is appropriate to recognize the maximum profits in the market. Next, expense recognition. We'll read about specific forms of expenses that first we read about inventory, and now we are going to read about depreciation. Now what is depreciation? I hope everybody knows about depreciation, but still let's get to it. If I purchase a fixed asset, let's say I buy a huge machinery, and I pay $1 million to buy it, will I use the entire machinery in 1 year? Obviously not. I will take a long time before I sell the entire machine. It will be a long time before I use the entire machine. I might use it for 10 years, 15 years, and I will be accruing benefits from the machine over that period of time. So should I expense the entire machine in 1 year? Obviously not. We will recognize this as an asset. We will recognize the historical cost of the machine, that is 1 million, as an asset in our books of account. So once it is recognized as an asset, every year we'll be expensing a certain portion. Now that amount, that the use of the machinery The write down of the value of the machinery is referred to as depreciation. So if I expect to use the machinery over 10 years, then what I will do is 1 million divided by 10 years gives us $100,000 of depreciation per year. Okay, so depreciation is nothing but the allocation of the cost of the fixed asset over its life. This simple method what we did is nothing but the straight line method of depreciation. Why straight line? Because every year we'll be recognizing the same amount as depreciation. So every year we'll be recognizing 100,000 as the amount of depreciation in our books of accounts. This is known as the straight line method. Straight line method of depreciation. Next, we will be learning about two more methods. We learned about straight line method and we'll be learning about declining balancing method, and we will just touch upon the double declining balancing method. As we learned in straight line method, the amount of depreciation is same every year. However, in case of declining balancing method, the value of depreciation keeps on declining year after year. Why does that happen? Now this is based on the idea that in the first year the machine is purchased, we will use it the most because there is no sort of wear and tear on the machine. Let us say you buy your phone. In the first year, it will run perfect, smooth. There will be no issues. But in the second year, you will find lag. It's not working properly. There's some delays. There's a lot of problem that is happening with your phone. So we all know that in the first year, we are able to use our fixed asset to its maximum potential. That is why in this method it says that we should allocate the maximum expense in the first year, and the value should keep on declining. So in the declining balancing method, a particular percentage of depreciation is given. Let us just keep that at 10%. So for the $1 million machine, in year 1 the value will be NWDV or written down value. Depreciation is 10% of 1 million, that is 100,000. So what is the written down value? 1 million minus 100,000, that is $900,000, right? So in year 2, how much will be the depreciation? Will it be will it be 100,000? No, it will be 10% of $900,000, that is $90,000. So you saw that how depreciation went from $100,000 and it reduced to $90,000. So now the written down value will come to $810,000. In year 3 it will be 81,000 and so on. Do you get the point? So this is how depreciation is calculated under the declining balancing method. Apply the constant rate of depreciation. Constant rate is a percentage rate that we already saw to an asset's book value each year. Book value is nothing but the written down value of the asset. And alternately, double declining balancing method, this is nothing but multiplied by 2. In some cases, in some assets, the percentage, let us say there's an asset which we expect to use very fast. So the formula of double declining balancing method is 2 multiplied by the formula, that is cost minus accumulated depreciation divided by life. So in case, since the percentage is not given, what we are doing is cost minus accumulated depreciation, which is nothing but the WDV. So WDV divided by life multiplied by 2. This is the simple formula of double declining balancing method. I hope you all understand the meaning of depreciation and how the different ways in which we can calculate depreciation. Now you also have one more word in our slide, that was amortization. And amortization. What does amortization mean? We all know about depreciation, so let us once more understand what does amortization mean. Amortization is the same, absolute same concept as depreciation. The only minor difference is the term depreciation is used for tangible assets, whereas the term amortization is used for intangible assets. For example, let us say that I applied for a patent. I developed a new product and I applied for a patent, which is a right to use that product so that nobody else can produce it. So if I applied for a patent or copyright or trademark, all these things are my intangible assets, which is giving me a benefit in doing business compared to my competitors. These are my intangible assets because there is no physical asset that I can hold in my hand. The name of my company, that is my physical asset. The brand value, that is not my physical asset. These are intangible assets for my company. These assets are amortized. The value of these assets are allocated in our financial statements through amortization. Now let us say, what if brand value, there's no say when the brand value is going to exhaust. We cannot put a life to my brand value. The brand value is going to stay forever. When do I amortize my brand value? I have capitalized the value of the brand value in my books of accounts. How do I amortize a brand value which has an infinite life? I do not know the ending of my brand value. In some cases, when the life of the intangible asset cannot be determined, then no amortization takes place. However, they are to be tested for impairment every year. Now, what is impairment? A new term. Impairment means we need to check whether the value of the asset has declined or diminished every year. We can do that through the impairment test. The impairment testing process is not relevant for level 1, but you will be learning that in future levels. Okay. So now let us come to what is the implication of all these for the what is the implication of all these items for a financial statement analyst. I am a financial statement analyst and I learned that the company is following the double declining balancing method, or they are following some other method. What is the implication of those expense recognition principles that the company is following? It is very important and relevant because I will get to know how the company is recognizing all of its expenses, right? And I will understand whether or not an additional expense is being, for example, the double declining method is more aggressive and it is expensing more right now than future. So the profits will be lower on today's date and lower at a future date. So we need to understand this. As analysts, we need to know how the expense is being recognized to understand the profitability and how the profits are going to be presented in the financial statements of the company. Apart from the depreciation expense, we also need to know about two different expenses. One being doubtful accounts, warranty expenses, and depreciation amounts. These can affect the net income of the company greatly because all these are a matter of policy of the management. The management can determine when and whether or not they need to put into any account into doubtful. What does doubtful account mean? Let us say I sold my goods to Mr. X and Mr. X went bankrupt tomorrow. I know I sold my goods, so I'm not getting those goods back. But can I recover the money from him any longer? I do not expect to do that. Since he has gone bankrupt, I do not expect that he'll be giving me anything back. So in that case, I will say that my account of Mr. X has gone bad debt. It has become doubtful, and I'll be removing that. I'll be writing it off in my statement of financial performance. I'll be writing it off as an expense in my books of accounts. It's called a bad debt expense or doubtful account. And whether or not the management wants to recognize the bad debt earlier than other companies, that is a matter of judgment by the management. For example, I might be a very hopeful person, and I might be in the management, and I might determine that I do not want to write it off just yet, and I will wait for the court proceedings to end before writing it off. Contrary to this, I might write it off as soon as I get to hear about the bankruptcy of Mr. X. So this is a matter of judgment. Nothing can be wrong, but depending on the judgment, the value of profit that is coming to the company might be different. So recognizing that all these expenses can have a major impact on my profitability. Similarly, warranty expenses are similar. Whether or not to expense the warranty, that is, for example, I give you a warranty that you will be able to exchange your product. I give you a guarantee that you will be exchange your product in case of any defects. As a managerial person, I might determine that out of 100 customers, 2% of people are going to invoke the guarantee, or I might be able to determine that 5% people are going to invoke the guarantee. This will cause a major difference in the expense that is being recognized by the company, and accordingly it will have a major impact on the profitability of the company. So let's read it. On the other hand, if a company's policies delay the recognition of expense, like I said, instead of 5%, if they expense only 2% of warranty, it can be considered an aggressive approach. The other one is a conservative approach. Using this as well as other information contained in the footnotes or disclosures, an analyst can recognize whether a company's expense recognition policy is conservative or not. The analyst should also recognize that it is possible that two companies in the same industry have very different expense recognition policies. Like I said, that as a person of the management, I might determine whether or not the expense of bad debt will be recognized today or 10 months later when the court proceedings end. So this is a matter of judgment on my part. As a financial analyst, it is very important for us to understand whether the management is conservative in its approach or aggressive. Depending on the conservatism of the management or the aggressive nature of the management, we will be formulating the future predictions and future revenue and expense predictions. Moving forward to non-recurring items. There are certain items which occur once in many years, and they might not occur again and again. So is it okay to recognize those as operating income and operating expenses, like we mentioned in the statement of comprehensive income? So both the IFRS and US GAAP require that a company reports the effect separately. Let us understand discontinued operations first. So let us say I am an edtech company and I acquire a new business, start a new business, not acquire, start a new business, let's say, apart from my already existing business. My already existing business is already going on. So I start a new business. However, after 2 years, I determine that it is not profitable for me to continue running the business and I want to shut it down. If I shut it down and I know that business is no longer going to continue, then it is referred to as a discontinued operation. Both IFRS and US GAAP require that a company reports the effect of discontinued operations separately in its income statement. So after we have completed the net income, then separately we will write income from discontinued operations, and then we'll write total net income. So we'll write income from continuing operations and income from discontinuing operations, and finally we will come to the total net income. This is mandatory as per both IFRS and US GAAP. See, discontinued operations are operations in which the company has disposed of or intends to dispose of, or in which it will no longer be involved. Like I already mentioned, if there's a vertical of a business, a company might be running many businesses. For example, Meta runs WhatsApp, Instagram, Facebook, lab business. There are many businesses. If at some point of time they determine to discontinue with the lab business, then the intention to discontinue also makes the lab business discontinued operations, and the income, any income that is being earned during the year while the lab business is still going on, but it is planned to shut it down, that is also supposed to be showed separately as income from discontinued operations. There are two terminologies which you need to keep in mind. One is the measurement date and one is the phase out period. What is the measurement date? Measurement date refers to the date on which the decision was taken to discontinue the operations. If I take the decision today to discontinue my operations, today will be called the measurement date. And let us say, whenever I take the decision, it is not like I can discontinue the operations from today itself. It will take some time for me to discontinue it, and there will be a certain period during which I will still continue to do the business, and I will continue to fulfill the already existing contracts before I completely shut it down. The period during which the operations still continue before shutting it down completely is called the phase out period of the business. I hope everything is clear regarding discontinued operations. Again, there are certain items which are very unusual and infrequent. For example, let us say a company is in distress and several lawsuits have been filed against the company. And in settling those lawsuits, the company incurred heavy expenditure. During that, the company almost went bankrupt, almost, but it's managed to survive. In such a case, the company might now start a restructuring process. The company might try to get back on its feet through the restructuring process. It might go to its creditors and lenders and ask them to take less money, give them discounts, request them to let them stay on their feet by giving them certain concessions. This is a restructuring process, and there's a whole lot of expenses relating to the restructuring expense itself. This is unusual and infrequent. A restructuring is not going to take place every day. This will happen once in tens of years. So that expense should be shown separately, and it should not be included as a portion of the total income. It should be shown separately. It should be presented separately as part of the company's continuing expense. I hope you understand, and there are many other examples, and I would love for it if you go to the internet and learn about it yourself. If you have any queries or want to know more about it from me, do ping me or do call me up, and I will be there to help you. Now let's come to non-recurring items. Oh, we have already, so one is we are going to learn about the changes in accounting policies and estimates. What are accounting policies? What are accounting estimates? And how are we supposed to present them? We already learned that accounting policies are very important for the recognition of both expenses, revenues, and everything else. They are set by the standard setters and are mandatorily required to be followed by the companies. However, the standard setters do allow the companies to take given options. They need to select one option. The companies have to select from among the few options that are provided to them. For example, in case of inventory that we heard, FIFO, LIFO, weighted average, and specific identification. Those were the options that were available to the company. A company is allowed to follow any of the four options. In that case, if let's say I am a company and I decide from now on, instead of FIFO, I am going to follow weighted average method. What should I do? I want to change my method of accounting policy. Am I allowed to do that? Because if I do change it, then the accounts will not be comparable. But there is a provision if the management feels that it is in the best interest and for better presentation that the company should change their accounting policy, then they are allowed to do so. They might move from FIFO to weighted average. However, it will require retrospective application. What does this retrospective application mean? They have to restate the previous accounts. Let us say I make the change in 2022. Change in accounting policy. Let us say I made the change in 2022. So in this case, I have to restate the accounts of 2021 as per the new policy. So while preparing the accounts of 2021, I have to put in a new figure. I cannot just copy paste of my last year's account. I have to change the value of inventory. As per FIFO it was prepared, I have to change it to weighted average. So I have to restate the accounts as per new policy. And I have to mention what is the impact of the change in the financial statements of the company. So this is the retrospective change that we need to present in case of a change in accounting policy. However, if there's a change in accounting estimate, then a retrospective change is not required. A change in accounting estimate requires only a prospective change. What does a change in accounting estimates? A classic example of change in accounting estimate will be, let us say I bought a computer and I expect that I will use it for 5 years. But in after 2 years only, the computer started showing many bugs. There were so many viruses in the computer, and now I think that I will be only able to use the computer for 3 years. That is one more year. In this case, I will not have to do any retrospective change. I can prospectively change it. So I will not have to do any changes in 2021's accounts. In 2022, I will simply charge additional depreciation. So let us say the machinery, the computer was $100,000, and as per 5 years, I was charging $20,000 as depreciation every year. $20,000 in 21, in 22, and in 23. I changed the life expectancy, and I expect it to be useful to me only for 3 years. So now I expect that the computer will be wasted in year 3. So the entire 100,000 multiplied by 3 years divided by 3 years. So I need to expense the entire 100,000 in this year minus 40,000, which has already been charged as depreciation. So in year 3, I will charge the entire depreciation of $60,000. I hope you understand the difference between change in accounting policy and change in accounting estimate. and how change in accounting policy is requires retrospective change, but change in accounting estimate requires only prospective change. Now another thing is prior period adjustment. This is for any errors that the accountant might have made. For example, let us say advertisement expenses were recorded as $100, but it should have been $105. So there was a $5 mistake that the accountant made. So in that case, we need to adjust the prior period accounts and present it in the new financial statements. However, we should make sure that if there are a lot of prior period adjustments occurring again and again in the company, then investors will be wary that the accounts are not fair. We just need to, these two are very important points, and we need to make sure that we understand how accounting policy and accounting estimates differ. Operating versus non-operating items. Next, this is a very small paragraph. We just need to understand the difference between operating and non-operating items. We have harped upon the two of these since yesterday, and I hope that I do not have to explain in detail, because yesterday also we talked about operating and non-operating items in a lot of detail. So let us just read what is written on the slide and then we'll move forward. When assessing a company's current or potential future financial performance, it is important to consider the effects of both operating and non-operating components. Operating means the expenses that are incurred for the operations of the company. Non-operating means others. For example, interest expense is a non-operating expense for the company. Non-operating components on the income statements include revenue and expenses items that were not generated during the regular course of business of operations. Due to the material nature of non-operating items, they are always reported exclusively, that is separate from the operating items. So interest expense is something that is a very major expense for most companies. The value of interest amount is generally pretty high depending on the company. That is why it is very material and needs to be separately stated. Non-operating items are typically reported separately from operating income because they are material and are relevant to the understanding of the company's financial performance. So all this we have discussed yesterday, and there is nothing new that we need to discuss about these right now. Under IFRS, there is no definition of operating activities, and companies need to use their judgment about which items can be classified as operating or non-operating. This is something that we need to know. IFRS, or the International Financial Reporting Standards, do not prescribe any distinction. However, under US GAAP, operating activities include all transactions and all events that are not defined as investing or financing. So technically, they have also not used a very good definition. What they have done is said, whatever is not investing or financing is operating. So if an activity can be said as investing, like I said, investing in an extra money in my FD. I am a company and I have some extra cash. I am investing it in a FD account. That is an investing activity. And financing, like we already mentioned, is like interest expense, borrowing money from lenders. All these are financing activities. So any activity which cannot be classified as investing or financing for the company is considered to be a operating activity. That is how the US GAAP defines operating activities. So we have completed the second part of this chapter. I hope you do not have any queries. In case you do, please feel to reach out to us. And before moving forward, we'll be taking a 10-minute break and I will be back at 12:10. See you again in 10 minutes. I hope you all take your break. Welcome back, everybody. Let us continue. We are in the last section of this chapter, but remember, these two chapters are practical and involve sums and are the most important. First comes earnings per share. Earnings per share basically means the total net earnings of the company divided by the total number of shares outstanding. Earnings per share is a very important profitability measure and depicts the earnings per ordinary share. Both IFRS and US GAAP require a company to present its earnings per share on the face of the income statement for net profit or loss. Let us see. Have they done it? Can we see the earnings per share of Facebook as a company? This is it. Earnings per share attributable to Class A and Class B common stockholders. So this is the earnings per share of Facebook as a company, and it is a very important financial measure, remember, because while determining a company's financial metrics, we need to understand how much is it earning per share wise. When I will be going out to buy the shares of company X, I should know that how much money is it generating per share that I am buying. The calculation of EPS depends on whether the company has a simple or complex capital structure. We'll get to this after a while. First, let us understand the first, let us get to the formula of basic earnings per share. So, basic earnings per share is net income minus preferred dividends divided by weighted average number of shares outstanding. So, let us do a small question to understand. Basic EPS. Let us consider company X earns $100,000 in net income and they pay $10,000 as preferred dividend. I hope everybody knows the meaning of preferential shares or preferred dividends, but if not, let me just describe this in short. Basically, there are two different types of shares that a company might issue. They might issue ordinary shares or equity shares, which has the ownership right of a company, or they might issue preferential shares, preferred shares. Those shares are guaranteed a dividend every year, unlike ordinary shares which might or might not get might not get any dividend at the end of the year. Preferred shares will definitely get some dividends that have been promised to them. So it is similar to a debt, however the capital is not promised back. That is why a preferred share is different from a debt. So after we reduce the preferred dividend, we get earnings available to equity shares, or earnings available for equity shares. Some people write 2, some people write 4. That is $90,000. And if I say that there are 1,000 equity shares outstanding, then what will be the basic EPS for this company? In this company, it is very simple. Net income minus preferred dividend divided by shares outstanding, equity shares outstanding, equals to 90,000 divided by 1,000 equals to $90 per share. So this was a very simple example of how we calculate basic earnings per share. However, now let us get into some details. What is weighted average number of shares? What is the top line? Okay. So let me take a more complicated example. Company X has 10,000 shares outstanding. At the beginning of the year. which is 1st of January. We will assume it is 1st January. ठीक है? Now, on 1st April, the company issued new shares. 4,000 new shares. So now the total shares outstanding becomes 14,000. But this new issue was made on 1st April. On 1st of July, the company distributes 10% stock dividend. They paid ordinary dividend, not preferred dividend. 10% stock dividend. And on 1st of September, the company repurchases 3,000 shares. Okay, so now the final outstanding number of shares is 10,000 plus 4,000 minus 3,000, that is 11,000 shares. So what is the weighted average number of shares? I'm sorry, in the question it was written as dividend. Basically, stock dividend is bonus. So they are giving 1 share for every 10 shares that you hold. So stock dividend is like a stock bonus. So you are being issued 1 share for every 10 shares you hold. So how will you calculate the weighted average number of shares? How will you calculate this? I hope everybody has written down this question in their own copies for better understanding. Now for calculation, let us see. Shares outstanding initially is 10,000 multiplied by 110%. Why do we do 110%? Because of the stock dividend. So these 10,000 shares will become 11,000 shares, right? So we are assuming that the stock dividend exists from the first day itself, right? So 10,000 will become 11,000 shares. That is for the stock dividend. 11,000 shares multiplied by 12 divided by 12. Since these shares were outstanding for the entire year from day 1 till the end. Now fresh issue. The new shares that were issued on April 1st, 4,000 shares were issued. On the 1st of April, that is January, February, March, 3 months have already passed. How many months are remaining? 9 months. So even in this case, since the stock dividend takes place after the 1st of April, the stock dividend or the stock bonus takes place on the 1st of July. So 4,000 shares will also become 4,400 shares. So that is why we are again doing 110% multiplied by 9 by 12, since these shares were outstanding for 9 months, right? This comes to 3,300. 4,000 multiplied by 110% equals to 4,400. Multiplied by 3 by 4 is 3,300. And finally, stock repurchase. 3,000 multiplied by. Should I do 110% here also? Just think and say. No. Because the stock dividend took place before the stocks were repurchased. If the stock dividend took place after the stock were repurchased, then we will do 110% for this as well. But since in this case, since the stocks have been already, the stock dividend took place before the stocks were repurchased, so we will not do 110% here. It was done in the 1st of September. So how many months left? September, October, November, December. 4. So 4 by 12. 4 by 12, 1 by 3, 1000. So what is the weighted average number of shares outstanding? It is 11,000 plus 3,300 minus 1,000. And the final figure comes to 13,300. This is the weighted average number of shares. So this is how you calculate the weighted average number of shares. So if a sum for BEPS, this can very well come in your exam and you need to be well versed with this. How to calculate a weighted average number of shares, how to calculate BEPS. Net income minus preferred dividend is very simple. Make sure you do not, if ordinary dividend is given, ordinary equity shares dividend, you do not subtract that. So keep that in mind. You only subtract preferred dividend given to preferred shares. So net income minus preferred dividend is the amount of income available to common shareholders, and weighted average number of outstanding shares is the time weighted average of outstanding common shares, which we calculated just now. This is how weighted average shares are calculated. Practice as many sums as possible. We will tell you which notes to follow so as to get as many practice sums you can get. Be well versed with every terminology, and in case of any doubts, feel free to contact us. Now, what we did was a simple capital structure. We will now move to complex capital structure. What is a complex capital structure? In case of complex capital structures, there is a thing called dilutive shares. What are dilutive shares now? There are certain debt or preferred shares which are convertible into equity. We know that today it is preferred shares or today it is debt, but at a future date it might convert into equity. You must have heard about convertible debentures or convertible preferred shares. All these are dilutive shares because at some point of time they are going to be converted into equity shares. So while calculating diluted EPS, so any capital structure in which there are any dilutive shares, that is any form of device which can be converted into equity shares as a future date of time, is known as a complex capital structure. In this case, the dilutive shares might be convertible debt, convertible preferred shares, share warrants, and anything else. Those are complex structures. In such complex capital structures, we need to calculate both the basic earnings per share and the diluted earnings per share. We need to understand the meaning of both and we need to calculate both. So how is diluted EPS calculated? In this calculation, we consider the effect of potentially dilutive securities. Like I mentioned, convertible preferred shares, convertible debentures, all these are potentially dilutive securities. If a firm has complex capital structure, it is to report both basic EPS and diluted EPS. How is this calculated? So the net income and minus preferred dividend. This is the same as basic EPS calculation. What is the new things? What is the new different things? We are adding back two things: convertible debt interest and convertible preferential dividend. So let us say there are convertible debentures in the balance sheet of the company. Right now we are paying interest to those debentures. Let us say there are 10,000 debentures for which we are paying $10 as interest per debenture. So $100,000 are being paid as interest for the convertible debentures. Once the debentures are converted to equity shares, will we still incur that interest expense? No, that interest expense will no longer be incurred. So what we do is we need to add that back. In the numerator, we add back the interest expense, and in the denominator we add the new shares issued or the convertible debentures into number of shares in which the convertible debentures can be converted into. What is this 1 minus t? This is the impact of taxes. So if interest was incurred by the company, let's say 100 rupees, for this 100 rupees the company would have gotten a tax deduction or tax benefit of, if the tax rate is 30%, of 30 rupees, right? So we would have gotten a 30 rupees benefit of tax. But now since there is no interest expense, we won't be getting that 30 rupees benefit. So we have to add back only 70 rupees. That is the after reducing the tax benefit. So we will be adding back the interest minus the tax benefits to the net income portion. And in case there is preferred dividend, if they are convertible preferred shares, then convertible preferential dividend, the dividend will be added back. However, preferred dividend is not tax deductible. That is why there is no tax adjustment that is taking place here. Let me remove that for ease of reading. So for interest, we are getting a tax benefit. That is why we are doing 1 minus t. And for preferred dividend, we are getting no tax benefits. That is why there is no tax adjustment taking place here. However, in certain countries, again, it might be written in the question that preferred dividend are tax deductible. So are you going to blindly follow this formula? No. We have to go by the question. There are certain countries where the preferred dividend is also tax deductible. In that case, what we will do is we will do 1 minus t in this formula as well. But remember, that is not the general case, and if nothing is mentioned, we will assume that interest is tax deductible and preferred dividend is not tax deductible. You need to keep this in mind, and both these formulas for diluted earnings per share and basic earnings per share, both these formulas are really important. Before moving forward, let us do a question on diluted earnings per share. I have brought this question for you. We'll do two questions, one for preferred one with preferred shares and one with convertible debentures or debt. Company X has a net income of $4,350,000. $4,350,000 is the net income, and had outstanding shares of equity shares, normal ordinary shares of 2 million. So there are 2 million ordinary shares outstanding. Apart from this, the company has 7%. 7% is the rate of preferred dividend. So whenever it's written 7% preferred shares, 7% is the dividend rate. 7%, $5 million per preferred shares. Preferred shares or preferred stock. Okay. And these preferred stocks are convertible into equity at 1:1 ratio. So each preferred stock can be converted into equity for 1:1 ratio. For each preferred stock, we will be getting one equity share. So I hope that you all remember the formula for basic EPS. So first calculate the basic EPS of the company. 4350 minus preferred dividend. Do not forget preferred dividend, which in this case is 7% of 5 million divided by 2 million. This comes to 5 million, 7% is 350,000. So 4 million divided by 2 million is $2. I hope everybody can do the basic math. 7% of 5 million, that is 350,000, is the preferred dividend that the company needs to pay. And after deducting the preferred dividend from the net income, 4.35 million minus 0.35 million gives us 4 million is the net income available to equity shareholders, divided by the total number weighted average of equity shares outstanding, gives us $2. So $2 is the basic earnings per share. Now this was simple. Coming to diluted EPS. How will we calculate diluted EPS? I hope everybody is trying on their own. Check the answer on the board only after you have completed trying for yourself. Okay? Okay guys, 1 second. I forgot to mention that each preferred share is worth $10. So the total number of preferred share outstanding is 500,000. Okay? I'm really sorry, I forgot to mention this. The total number of preferred share outstanding is 500,000. Outstanding is 500,000 preferred shares. Alright. Try the sum on your own and I will be writing the answer after you have completed trying. Okay, so let's get to it. So we are getting diluted EPS equals to net income minus preferred dividend plus convertible preferred dividend. What is the difference? Certain preferred shares might not be convertible, so that will not be added back. In this case, the entire preferred dividend that we are receiving is added back, so these two can simply cut off. But in certain cases it might not be the same, and some preferred shares might be convertible and others might not be convertible, divided by weighted average equity shares plus convertible preferred shares, equal to 4.35 million divided by the number of shares was 200,000 plus number of equity shares, preference shares convertible will be 500,000, 2.5 million. So 4.35 divided by 4.35 divided by 2.5 gives us 1.74. So the diluted EPS in this case is 1.74. So I hope everybody can see how the diluted EPS will always be less than the basic EPS. This is something we need to keep in mind. The diluted EPS will always be less than the basic EPS. Now let us understand, before moving forward, let us understand the concept of anti-dilutive shares. Now in certain cases, see, we are adding something in the numerator and the denominator. In very rare cases, there might be certain outstanding shares where the numerator being added is greater than the denominator. So the value of diluted EPS will become greater than the basic EPS. But we are not supposed to do that. Such securities are called anti-dilutive securities. Any stock options, warrants, convertible debt or convertible preferred stocks that increase the EPS are called anti-dilutive securities. This is also something that is mentioned. We have not mentioned this in our slides or PowerPoint presentation, but this is something that you need to keep in your mind. Meaning of, acha, this is here. Anti-dilutive. So anti-dilutive shares are which increase the basic EPS after the adjustments that are being made. So such securities should not be included in the calculation of dilutive EPS. So these securities which are anti-dilutive are to be ignored while calculating the diluted EPS. Should we do another sum on diluted EPS before moving forward to common size statements? Okay, let's do one more sum. So we'll calculate EPS where there is convertible debt in this case. Okay. So Y company had earnings of $2.5 million and outstanding equity shares of 1 million. So that 1 million outstanding shares and 2.5 million. So this 2.5 million is the amount that is attributable to the equity shareholders. That is after any adjustments for interest. This is PAT, profit after tax. So the basic EPS comes to simply 2.5. No complications here. Basic EPS is 2.5. However, they have 2,000 $1,000 debentures, 5% interest rate. So there are 2,000 debentures outstanding worth $1,000 each, on which the applicable interest rate is 5%. Now each debenture can be converted into common stock of 120 shares each, and the applicable tax rate is 30%. I have given all the information that is relevant for completing this question. Please try and calculate the diluted EPS by yourself, and I will be solving the question in 2 minutes. Excuse me. Okay, so let's start. So the debentures, the 2,000 debentures can be converted into how many shares? So number of shares, that will be the fresh shares will be 2,000 multiplied by 120 equal to 240,000 shares. This is the addition to the denominator that we have to make. What about the numerator? The income, the interest portion, net income plus convertible interest multiplied by 1 minus t divided by 1 million plus 240,000 equals to, what was the net income? 200 2.5 million. 2.5 million plus how much is the interest that needs to be added back in this case. So we know 2000 debentures multiplied by $1,000 each debenture multiplied by 5%, and adjustment for tax is 1 minus 30% divided by 1. How much does this come to? This entire right side comes to $70,000. You can do it on your calculator. So 2.5 million plus $70,000 divided by 1.24 million. This figure comes to $2.07. So this is the final figure for your diluted EPS. I hope everybody got the same answer. Moving forward. Moving forward, let us just get to determine how will we determine whether a share or whether a convertible debenture or convertible preferred share is dilutive or anti-dilutive. There's a very simple check for that. How to check whether any convertible preferred share or convertible debentures are dilutive or anti-dilutive? We simply we put the numerator whatever we are adding in the numerator. So in this case it was convertible debt interest into 1 minus t, and we divide this figure by the number of shares that we'll be adding. Convertible number of shares. In this case it comes to $70,000 divided by 240,000 shares. Since this figure, this is the diluted figure, this figure is less than the basic EPS. Since this figure is less than the basic EPS, which is 2.5, hence we know that it is a dilutive share and not anti-dilutive. Instead of 70,000, had it been $700,000, 700 divided by 2.4, that would be so my calculator is not working. Anyways, so in case this figure comes to less than the basic EPS, then we know that the convertible share or debenture is dilutive. In case it is greater than the basic EPS, then we will determine that it is anti-dilutive and we need to ignore it. You just need to know the concept of anti-dilutive. I do not expect to see that question in the exam. Now finally we come to the last sections. Common size statement. Common size statement is a way of looking at the financial statements of the company in a simpler manner. Let us say I'm comparing two companies. Let us take the example that is on the screen. So ABC company and XYZ companies are two companies. When I go to invest in in either of the companies, what I'll see is that the operating profit of ABC is 7.5 million, whereas the XYZ is only 1.575 million. So in this case, which company do you think is better? Is ABC better or XYZ better? Many people will think that ABC is much better, but we need to look deeper. Let us consider the revenue to be 100%. So 75 million for ABC is 100% and 3.5 million for XYZ is 100%. And now let us represent every expense as a percentage of the revenue. So 52.5 million divided by 75 million is 70%. So 52.5 divided by 75. This is 22.5 divided by 75. I hope you all get how the calculations for the common size statement has been done. This is the normal income statement and this is the common sized income statement. So in a common size income statement, all the figures are presented as a percentage of the revenue of the company. This helps us put large companies and small companies into perspective so that we do not involve the bias of large numbers. In this, we can see that the gross profit of company ABC is only 30%, whereas XYZ is earning a gross profit of as high as 80%. This is also known as the gross margin. This is the gross margin, that is the gross profit divided by the revenue of the company, gross margin of the company. And finally, when we come to operating profit now, we see that ABC is earning an operating profit of only 10% as against an operating profit of 45% for XYZ company. So we understand that there's a major difference between the profitability of the two companies. Since the gross profit percentage is known as the gross margin, I hope you all can guess what the operating profit percentage is called. It's called the operating margin. And you need to remember these two words as well. What is gross margin and what is operating margin? Gross margin is nothing but the gross profit divided by the revenue of the company, and operating profit is nothing but the operating profit divided by the revenue of the company. Similarly, net margin is the net profit divided by the revenue. I hope this is very simple to understand. Let's just read what is written once. Conversion of the income statement of common size statement facilitates an assessment of a company's performance across time periods and across companies. So across time periods and across companies. Why? Because even though the companies are severely different in their size, 75 million revenue for ABC and only 3.5 million revenue for XYZ, yet with this common size statement we are able to compare the profitability of the two companies and across time. So if we see the for example, these were different years of the same company, then we'll be able to see how is the margins of the company and what is the percentage of expenses and what is the percentage of profits that the company is able to earn over different time periods. And finally, comprehensive income. So yesterday we talked about how a total comprehensive income is goes beyond the net income. After we get the net income of the company, we add these four items. There might be other items as per the specific standard setting body and the accounting standards of your specific country, but these are general items that are available in both IFRS and US GAAP and are collectively called other comprehensive income. Once we add other comprehensive income to the net income of the company, what we get is called the total comprehensive income. You do not need to understand what are the meaning of the four other comprehensive income, but you just need to know what they are. That is the names of these four other comprehensive income. The detailed, these are very complicated items and it will be discussed at future levels. So it will be present in level 2 for you. But you just need to know the names of the four other comprehensive income. That is foreign currency translation adjustments, adjustment for minimum pension liability, unrealized gains and losses for derivative contracts used for hedging, unrealized gains or losses from available for sale securities. You just need to know the names of these four items. You do not need to understand what they stand for. So how will you learn? One is foreign currency, pension, derivative contracts, and available for sale securities. These are the four items that you need to remember. Okay, now let's just take a quick 2 minutes break and then I will be reciting everything that we have done today and then we'll end the class. Give me 2 minutes of break. Okay. So now let's just go through everything that we do today in super speed. Today we learned about LOS 18, which is understanding income statements. We saw what are the points that CFA wants us to remember after we have learned this chapter. Number one, components of income statement. What are the components? The components of income statement are revenue and expenses. Revenue minus expenses give us net income. Gains and losses, which are non-operating type, are also part of the income statement. We learned about what is minority interest. Minority interest is if a parent company has a holding in a subsidiary company in which there is certain percentage of shares held by others, then that is referred to as minority interest, and that has to be reduced or removed from the consolidated net income of the company. Then we learned about the different presentation formats for an income statement: single step and multi-step. In the single step format, there are no distinction made, whereas in a multi-step format, there is a separate presentation of gross profit and operating income. Everything is presented separately. Gross profit and gross operating profit is mentioned separately. Then we went to revenue recognition. What were the 5 things, what were the 5 steps that must be followed in order to recognize the revenue? Number one, identify the contracts with the customers. Then identify the separate distinct performance obligations in the contract. After that, we will determine the transaction price, which is the money that is expected to be realized, and then we allocate the transaction price to each performance obligation. And finally, we recognize the revenue when and as and when the performance obligation is satisfied. Then we moved on to treatment of related costs. Incremental cost for obtaining a contract needs to be capitalized over the life of the contract. If a contract is for 3 years, the contract obtaining incremental cost needs to be capitalized and expensed in each of the years. If the incremental costs were expensed in the years before the converge standards were presented, then the financial statement analyst must know that the profits will be distorted. In the first year, the profits will be lower, and in the following years, the profits will be higher. Then we learned about the disclosure requirements for the revenue recognition standard, which were: number one, contracts by each customer category needs to be stated separately. Assets and liabilities related to contracts, including balances and charges, needs to be mentioned. Outstanding performance obligations and the transaction price allocated to them needs to be mentioned. And finally, management judgments to determine the amount and timing of the revenue recognition, including changes to those judgments, needs to be stated. Then we moved on to expense recognition. A company recognizes expenses in the period in which it consumes the economic benefits associated with such expenditure. We learned about the matching principle, in which a company should recognize the expense when the relevant revenue in relation to that expense has been recognized. And periodic costs for certain costs which were paid on a period to period basis and could not be specifically annexed to any particular revenue, and hence they were recognized as per the period in which they were actually expended. Then we moved on to inventory expenditure. We learned about FIFO, LIFO, weighted average, and specific identification. In FIFO, first in, first out. We assume that the goods that were purchased first are sold first. In LIFO, the complete opposite. The goods that were purchased last have been sold first. Weighted average is somewhere in the middle, where we average out the weight. And finally, specific identification is we expense only the goods that have been sold, specifically identifying the costs that were incurred to sell the particular good. Then we moved on to depreciation. We learned the meaning of depreciation is the allocation of the of expense of a machinery or any good which will be used for multiple periods, and allocating the expense across those periods. We learned about the 2-3 methods of depreciation: straight line method, where same amount of depreciation is charged every year, and the declining balancing method, where a constant rate, the rate is constant but the amount reduces year by year. In year 1, the depreciation figure is the highest, and it keeps on reducing as we move forward. Double declining method is just the multiplying the declining balancing method by 2. Then we learned about the implications of expense recognition. We learned about how bad debts and warranty, and there are many expenses which have a large portion of management decision making involved, and it is very subjective in nature. Hence, we need to understand whether management is conservative or aggressive in expensing those, which will help us to determine the future forecast for the company. Then we learned about non-recurring items, which are discontinued operations and unusual or infrequent items. Discontinued operations are those operations which the company does not plan to continue. If a company has many business verticals, then the vertical which the company has already shut down or plans to shut down is a discontinued operation, and it needs to be presented separately in the income statement. Unusual or infrequent items are items which happen once in a blue moon, for example, business restructuring. Then we learned about changes in accounting policies and accounting estimates. Accounting policies were major changes. For example, changing from FIFO to LIFO is a major change and is an accounting policy change, and it needs to be presented retrospectively. Whereas accounting estimates are smaller changes. For example, changing the number of years for which the company expects the machinery to be used, that is to be done prospectively. The change will be prospective. And there are prior period adjustments. If there is a error in the prior period item in a prior period financial statement, that needs to be adjusted in the financial statement. And if a company has many prior period adjustments year after year, then it will reduce the reliability of the analyst on the financial statements prepared by the company. Then we learned about the difference between operating and non-operating items, which is very obvious since it is there in the last year, in last readings also. Then we finally came to earnings per share, that is how much money is the company earning per share. So we divide the total net income of the company minus the preferred dividend and divide it by the weighted average number of shares outstanding. Then we learned something about complex capital structures. What is complex capital structures? Complex capital structures means when there are dilutive shares in the company's financial statements, then it is a complex capital structure. Dilutive shares might be convertible preferred shares, convertible debentures, it might be share warrants, and anything else which will be converted into normal equity shares. How do we calculate diluted shares? Net income minus preferred dividend, that is the normal formula for basic EPS numerator, and we add back the convertible preferred dividend and the convertible debt interest. The convertible debt interest needs to be adjusted for tax because it is tax deductible, and convertible preferred dividend will not be adjusted. However, the question might state that convertible preferred dividend is tax deductible. In that case, we also need to adjust the convertible preferred dividend for tax. While dividing, we divided the weighted average number of shares plus the new shares that will be issued. And finally, we came to common size statement. Common size statement help us to facilitate comparison between companies of different sizes and across different time periods for the same company. We present every line item as a percentage of revenue. And finally, we learned about other comprehensive income needs to be added to net income to give us a total comprehensive income. The four components of other comprehensive income are foreign currency translation adjustments, adjustments for minimum pension liability, unrealized gains or losses on derivative contracts used for hedging, and unrealized gains or losses from available for sale securities. That is all for today, guys. Thank you so much. I hope you had a fun time learning. If you have any queries relating to LOS 18, feel free to contact us. And next day we'll be picking up LOS 19, which is understanding balance sheets. Thank you, everyone. We will end now.